This is Diddy, and he has $1,000 again. This time, he did his homework. He watched every How to Invest in Your 20s video on YouTube. Index funds, ETFs, retirement accounts, the whole thing. He's ready to click buy on some boring fund and let it sit for 30 years. He stumbles on a video from a guy who built a business empire worth over $100 million. And he says something that stops Diddy mid-scroll. Don't invest in the S&P, invest in yourself. Come again? Here's the logic, and it's simple. If Diddy puts $1,000 in the stock market and it grows at a solid 10% a year, that's $100 in year one. $100. Meanwhile, if Diddy spends that same $1,000 learning a skill that lets him earn an extra $500 a month, freelancing, coding, sales, running ads for a local business, whatever, that $1,000 basically pays for itself in 2 months and then keeps paying him every month after that. The claim here is that you'll pretty much always get a higher return investing in your own education and skills than you will from any stock market, at least early on when your pile of money is still small. So Diddy rethinks the whole plan. Instead of $1,000 lump sum sitting quietly in a brokerage app, he splits it into 3 buckets: tools, learning, and testing. Bucket 1. Tools. Whatever gear or software Diddy actually needs to do the skill. Even something as basic as a laptop upgrade or a subscription to software he'll use daily. Bucket 2. Learning. Not random YouTube videos he watches half asleep. The whole point is, if you're in the same room, staring at the same screen, and nothing in your actual behavior changes, you didn't learn anything. So Diddy puts money towards something with actual feedback. A course with assignments, a mentor, anything that forces him to do the thing, not just watch it. Bucket 3. Testing. A small slice of cash to actually try the idea in the real world. Running a tiny ad, taking on one small paying client, launching the thing badly instead of planning it perfectly. He picks one thing, one product, one type of customer, one channel, and he sticks with it instead of chasing 5 ideas at once. Diddy stops bouncing between maybe I'll flip sneakers and maybe I'll do drop shipping and maybe crypto every other week. He picks one lane and actually gets good at it. And here the extra money starts coming in from this new skill. He doesn't go upgrade his lifestyle. He keeps his spending exactly the same and shoves the new income right back into getting better at the thing. That's the loop. Skill brings in cash, cash gets reinvested into more skill, and the whole thing snowballs. Way faster than $1,000 sitting quietly in an index fund ever could, at least according to this guy. Does that mean the index fund plan Diddy saw in every other finance video is wrong? Not exactly. The bet here is that in your 20s, your biggest asset isn't your $1,000, it's your time and your ability to earn more of it. You've got decades to recover from a swing that doesn't work out, so this is the moment to take a bigger one. That's a real trade-off though. Building a skill or a small hustle is a lot riskier and a lot less predictable than a diversified fund that's been tested for 100 years. There's no guarantee it works out the way it did for him. So maybe the real answer for Diddy isn't index fund or invest in yourself. Maybe it's both, at different stages, depending on how much risk he's okay taking on right now. That's the core idea in a nutshell, but obviously we squeezed a lot into 6 minutes here. If you want the full breakdown straight from the source, go watch Alex Hormozi's video. I'll drop it right after this one. And like always, don't just take Diddy's word for it, go dig into it yourself before you decide what to do with your own $1,000.